welcome back to Global Value. Today we're performing a fundamental stock analysis of the New York Times Company, ticker symbol NYT. The New York Times is currently trading for $36.48 per share. Over the past year, their stock price is down 22%. Over the last 5 years, their stock price is compounding at a rate of just under 9% annually. Over 10 years, they're compounding at a rate of 15% annually. And going back prior to the global financial crisis, over the last 18 years, the New York Times' stock price is basically exactly flat, down less than 1% over this period. The company is up more than 9 times from their lows in February of 2009, and although they've been flat over this time frame, since they hit their lows, they've been one of the top performing legacy newspaper businesses. Keep in mind that the company also pays out dividends. Currently, they have about a 1% dividend yield, so their average dividend yield throughout this time frame would be added to this compounded annual return. So the New York Times is currently trading snugly between their 52-week high and their 52-week low. They're a little closer to their 52-week low, but not by much. Right now, around 3% of the company's shares outstanding are sold short, and the New York Times has about a $6 billion market cap. For more background about the business, the New York Times Company is an American media company known for publishing its flagship newspaper, the New York Times. The company also operates the International New York Times newspaper, as well as digital properties such as NYT Times and various smartphone applications. Circulations of the New York Times is the source of revenue for the company, followed by print and digital advertising and its paid digital only subscription to the New York Times. The company has a daily print circulation of over 3 million newspapers and 7.4 million newspapers on Sundays. The source of growth for the New York Times has been its digital subscription service, which has over 1 million paid users. The company also transmits articles, graphics, and photographs from the Times and other publications to approximately 1,500 newspapers, magazines, and websites. Additionally, the company operates Wirecutter, a product review and recommendation service. It also develops mobile apps, including games, cooking products, print and distribution products for third parties. The New York Times was founded in 1851 and is headquartered in, you guessed it, New York, New York. So for our fundamental analysis today, we're performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of the New York Times based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 major reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by looking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In most of these years, the New York Times has earned pretty stable and pretty steady mid-teens return on capital over these years. They did dip to just slightly below 7% returns on capital in 2020. Since then, though, their returns on capital have rebounded. However, when we average out these returns on capital, they're going to be coming in just very shy of our 14% benchmark, coming in at around 13.3% over this time frame. So less than a percentage below that 14%, even though they're solidly above average. This is going to be an X here to start things off on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over their last 5 years. This metric will be all or nothing in nature. Either all 3 of these will be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time frame, the Times has grown their revenues by about a third, so they've grown them by 32%. Their earnings are also up by about 38%, and their free cash flows have grown by 43%. All 3 of these are up here. This is a check on metric number 2. And it's especially great to see that the business was strongly cash flow generative in all 5 of these years. In fact, the company had their highest amounts of free cash flow in 2020. It's great to see that this growth is being led by their free cash flows, because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back in their business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So again, this is our first check of the day here on metric number 2. Next up for metric number 3, here we're looking at the business from the perspective of an individual shareholder in the Times. So we're looking for earnings per share growth over their last 5 years. So we learned in our previous metric that their earnings have grown by 38% over this time frame, and over the same period, their shares outstanding are basically flat. So they've just marginally diluted existing shareholders, meaning that their earnings are going to be driving this earnings per share growth in the business. And so this is a check here on metric number 3. In their most recent fiscal year, the New York Times earned $1.04 for each share that they had outstanding. Next up, for metric number 4, we're looking for free cash flow per share growth over the last 5 years for the business. So a very similar situation to their earnings per share. Their free cash flows have grown by 43%, and with just their marginal shareholder dilution, this means that the company has grown their free cash flows per share. So this is a check here on metric number 4. In their most recent fiscal year, the New York Times produced 68 cents for each share that they had outstanding. And recapping where we stand currently, through our first 4 metrics, we have 3 checks and 1 X for the New York Times. Next up, for metric number 5, here we're evaluating how the business is using debt. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that will be at the greatest risk of poor potential outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over their last 5 years. So in all 5 of these years, the New York Times has had negative net debt. What this means is that after paying off all of their debt, the company is actually left over with cash. So currently the company has about a $417 million cash cushion on their balance sheet. And with the business being cash flow positive in all 5 of these years, this is a very strong check here on metric number 5. Not only is the business sitting on a significant cash cushion, they've also produced $836 million worth of free cash flow in their last 5 years. So the New York Times looks like its balance sheet is in a very strong and very healthy position here, and the business is strongly cash flow generative. And in their most recent fiscal year, the company produced $114 million worth of free cash flow. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may offer us a slight risk premium to the yield of the 10-year treasury, and it may offer us a reasonable starting point for evaluation of the business. We learned in our last metric that the Times has produced $836 million worth of free cash flow in their last 5 years, meaning that in an average year, they earn $167 million of free cash flow. And currently, the New York Times has a $5.6 billion total enterprise value. So we're using their enterprise value here because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the business that's more similar to as if the New York Times were a private company. So when we divide their $167 million of their average free cash flow by their $5.6 billion total enterprise value, that gives us about a 3% average free cash flow to enterprise value yield for the business. That's coming in both below that 5% risk premium and below the yield of the 10-year treasury as well, meaning that this is an X here on metric number 6. Something I'll also be interested in is that even though the company has grown their free cash flows overall throughout this time, their free cash flows in their most recent fiscal year are below where they've been at averaged out over this period. And so currently the company has about a 2% current free cash flow to enterprise value yield, based off of dividing their $114 million of their last fiscal year's worth of free cash flow by their $5.6 billion total enterprise value. So just because both of these are coming in below that risk premium we were looking for, and this is an X on metric number 6, doesn't mean that you're necessarily going to toss this business out in its entirety. This is one of our 6 metrics, and while these metrics are simple, when they're combined together, they can be very powerful. This analysis is meant to be holistic, and it's not financial advice. And even though this is our last metric, you'll want to stick around until the end of the video. We still want to come to a more concrete intrinsic value estimate of the business. As a bonus, before we look at another way of calculating their intrinsic value, here we're taking a look at their dividend profile. So the Times currently pays out a 1% dividend yield, and we want to look at the business to see whether their dividends are healthy and supported by their free cash flows. That's been the case in all 5 of these years, with the New York Times both growing their dividends payouts and growing their free cash flows as well. Even though the company has a higher dividend payout ratio in their most recent fiscal year than they have through any of these other previous years, it still looks like they're able to support their dividends using their free cash flows. Although again, their dividend payout ratio has increased more recently. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze the New York Times, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for the New York Times. So a discounted cash flow model is based off the predictability of a business's future free cash flows, and it's just like any other model in any other discipline, its outputs will be sensitive to its inputs. So here we're starting with an average of the company's free cash flows over their last 3 years, and we're using historical growth assumptions dating back all the way until 1990, in order to project these out into the future, so it's up to you to do your own homework here to determine whether or not these historical growth assumptions will be accurate and applicable going forward to give us a baseline projected estimate for the New York Times. If we assume that they can grow their average free cash flows at a rate of 5% annually over their next 10 years, and then assume that these grow at a rate of 4% annually for the 10 years out after that. If we add in the company's tangible book value, which gives us an estimate of the business's net worth, and we were ideally seeking a 15% rate of return from the New York Times, which is the rate of return that Warren Buffett is looking for from his investments, in addition to his margin of safety requirements depending on the business, then it looks like at today's valuations of the New York Times that a potential fair intrinsic value for the business is just under $16 per share. That's down significantly from what the company's current stock price is, with their current stock price needing to be cut in half in order to reach that fair value. Please keep in mind some caveats here. One is that their dividend yield, although it's slight at 1%, would be included in this 15% rate of return, so we would not be doubly counting dividends. Another point to consider is that the business has not been the most predictable in their past. This is especially due to the shifting nature of the newspaper industry throughout the past 20 years or so. The New York Times had to make a huge digital transformation of their business. Their free cash flows have been less predictable than what they would have been in, let's say, the 20th century. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, the New York Times checks the box on 4 out of 6 metrics, meaning that they're a strong candidate for further research. The company has earned above average returns on capital, but they fall just shy of our 14% benchmark. They have grown their revenues, earnings, and free cash flows over the last 5 years, and they've grown these on a per share basis as well. The company has a cash cushion of more than $417 million on their balance sheet, and they've been strongly cash flow generative in all 5 of their last years, generating more than $800 million worth of free cash flow. However, on both a current and an average basis of their free cash flow to their enterprise value yield, it doesn't look like the company would be offering a risk premium in comparison to the yield of the 10-year treasury, and that both of these yields would be coming in below the yield of the 10-year treasury. Looking at their dividend profile, the company has supported a growing dividend payout in all 5 of the previous years, although their dividend payout ratio has increased in their most recent fiscal year. Finally, performing a discounted cash flow analysis of the New York Times. If you've done the work and you believe that those historical growth assumptions will be accurate and applicable going forward for the business, then it looks like at today's valuations of the company that a potential fair intrinsic value for the business is just under $16 per share. It has been some time since the business has traded around that price, and the last time they were near there was back in April of 2017. So if that's the case, you would just want to be patient. It's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about the New York Times. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand what's important and what's not important for the business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of their business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of the New York Times Company, ticker symbol NYT. With the Times checking the box on 4 of our 6 metrics, it looks like they're a strong candidate for further research, as it seems like they have a high-quality business that potentially has a lofty multiple right now. It was nice to take a look and make an analysis of the company, so if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about the New York Times with me, and have a great day.